You picture yourself behind the wheel, imagining the status. The desire for a specific vehicle immediately collides with the cold reality of a monthly budget. Most buyers navigate this conflict in the exact wrong order. They select the trim, the color, and the interior upgrades before they ever run a single calculation on their finances. They sit at the dealership desk, ask how much the monthly payment will be, and agree to whatever terms keep that single number below their pain threshold. This negotiation plays out in the background. A standard 60-month agreement quietly stretches to 84 months, creating a massive pocket of extra interest. To keep the monthly payment low, you pay thousands more over the life of the vehicle. The only defense against this math is to build your plan in reverse. You start with your hard limits, calculate your total capacity, and work backward to the car. Buying a vehicle based purely on desire does not secure you a better ride. It secures a longer, more expensive financial trap. The first step bypasses the showroom entirely and begins with your salary slip, specifically your true monthly take-home pay. Your absolute maximum car payment, your EMI ceiling, is bounded between 10 and 15% of your take-home pay. At 10%, it barely registers. At 15%, you hit the safety limit. Cross that, and one bad month destabilizes everything. A broader household guideline is the 24-10 rule. That final metric dictates keeping all transportation costs under 10% of your gross income, not just the loan payment. That means accounting for fuel, insurance renewals, and routine maintenance. None of these expenses pause to accommodate your EMI. If you stretch your monthly budget to afford a higher loan payment, you leave zero margin for new brake pads or a major service bill. A rigid budget ceiling must leave breathing room for the actual costs of operating the vehicle. Otherwise, affordability is an illusion. The next variable is cash up front. Every rupee you pay toward the down payment is a rupee that entirely escapes interest charges. Aim to put down at least 20% of the vehicle's total price as a starting target. Put down significantly less, and standard vehicle depreciation works against you. In the first few years, the car's value drops faster than you can pay down the principal, leaving you owing more than the vehicle would fetch on the open market. But a massive deposit loses its advantage if it drains cash reserves. Protect your emergency fund first, and only put down what you can spare. Then comes the reality check. The attractive price printed in the dealership brochure is the ex-showroom figure. For budgeting purposes, that number is entirely useless. Before delivery, you pay registration fees, state road taxes, and insurance premiums. This equation shows the true calculation. Take the inflated final on-road price and subtract the safe down payment you secured earlier. The remainder is your required loan amount. Basing your budget on the ex-showroom sticker guarantees a sudden cash shortfall the moment the delivery paperwork arrives. Now you hold two separate figures: the exact amount of money you need to borrow and the maximum loan your monthly income can safely afford. Looking at this balance scale, your affordability limit must equal or outweigh the loan you need. If the scale tips into the red, you have three sound moves: increase your down payment, select a cheaper car, or delay the purchase to save cash. Do not artificially stretch the loan tenure just to make the monthly payment fit. That simply disguises an unaffordable car as a manageable expense. With the exact loan amount established, you can finally shop for interest rates and compare lenders. Executing this process in reverse protects your income. The vehicle remains a reliable tool for mobility rather than a heavy anchor dragging on your finances. True financial peace of mind comes from dictating the math on your own terms before you ever step onto the lot.